So tonight we're going to take a look at everything that's going on in the stock market relating to the COVID-19 coronavirus, the bear market that has just begun, the threat of a recession. We're going to talk about it from the perspective of long-term savvy uh, growth-oriented investors, and we'll also talk about what your investment club should be doing now. We've got a lot of material that I'm going to be covering tonight. I wanted to give you a good in-depth look at pandemics and recessions and growth markets to provide some perspective that you can utilize in making better investing decisions. So I'll be splitting the presentation into two sections. First, we're going to talk about everything that's going on in the market, and then we're going to talk about some more practical tips for your investment club that should help you to make some better investing decisions. So let's start with what's going on in the markets. Now today, March 17th was actually a rather good day for the market. We saw a little bit of a recovery, but we are in the midst of a global health crisis, and that is first and foremost on in the minds of many investors. It's in the first story in the headlines. The World Health Organization officially declared the COVID-19 coronavirus pandemic back on March 11th, 2020, and the cases and deaths continue to rise. Yesterday, the cases had been reported in 49 states. Today, they've been reported in all 50 states. There is obviously an ongoing debate about the pace of U.S. response, so that we expect to continue. I think a lot of people in the country still don't see the big risks, the threat of the COVID-19 virus. We'll talk a little bit about that, but we've got borders, states, cities going into lockdown. We've got some major cities like San Francisco that have implemented shelter-in-place rules, which means you can't leave your home except for very good allowed reasons. And New York City is considering the same, to cut down on the amount of social interaction and to inhibit the transfer of the virus from one individual to a next. Many, many, many businesses are being closed by government mandate, others closed voluntarily. In some states, all restaurants, all bars, all movie theaters, all gyms are closed. Places where people congregate in close quarters, gatherings of greater than 50 people are prohibited in many areas as well. And undoubtedly, this is going to have a big economic impact on the country. And that is driving a lot of investor behavior as well as panic behavior of Americans and people around the world. But the potential impact can be looked at in a couple of different ways. One of the key things that you'll read about is the efforts to so-called flatten the curve, which is to delay the transmission of the virus so that fewer people get it over a longer period of time, rather than a lot of people spiking with the virus and the symptoms in the short term that would overwhelm healthcare. And we'll talk about that as well. Here's where we stood as of earlier today. This is a logarithmic scale, which you should be familiar with from the stock selection guide. So we're measuring the rate of change of, on the left, total cases reported worldwide, and on the right, total deaths reported worldwide. If you understand a logarithmic scale, the fact that we see this little bit of an uptick both in total cases and deaths on the right side of the graph is troubling, because that's indicating that the growth rate is increasing, not decreasing. We know the numbers are going to increase, but we want to see the growth rate, the percentage of cases slowing over time. That's not happening yet, which brings us to the flatten the curve element. Without protective measures, the area in the red is if we don't do anything. If no one does anything, everyone goes about their business as normal, and this very virulent virus transfers from one person to the next, we'll have a lot of cases in a short amount of time. If we start to inhibit that transfer of the virus, then we see the curve flattening out, and that's indicated by the blue line. The total number is the same in both cases, but if we have protective measures, we don't overtax the healthcare system, we still will see the economic impact of businesses that are shut down and healthcare costs, et cetera. But this will enable the healthcare system to treat people more efficiently, more effectively, and lower the death rate. So the risk is very real, and this is something that we haven't dealt with in the U.S. In a very long time. Certainly in most of our lifetimes, we've never seen a pandemic of this scale. Elsewhere around the world, they have encountered them. So there's a lot of knowledge about transmission of viruses. So I would just urge you all to stay at home, especially if you're in a higher risk category. Now, trying to understand something like the COVID-19 coronavirus, I think is helpful if we look back at some of the major pandemics of the 20th century. Starting off with the Spanish flu, the so-called Spanish flu in 1918, 1919. An estimated 1/3 of the world population at the time came down with the Spanish flu, and 50 million people or more died. And there are, it's hard to tabulate the deaths relating to the Spanish flu. This is 100 years ago. Medical technology is not what it is today. Some estimates put that number closer to 100 million, but the mortality rate was probably around 2.5%. 50 million people passing away. That's a pretty significant health crisis. In 1957 and 1958, which may be within the lifetime of some of the people who are here, the Asian flu swept the United States. This was the H2N2 virus, which killed 1.1 million people worldwide. Estimates range as high as 2 million people who passed due to the Asian flu. There were about more than 100,000 people who died from the Asian flu in the United States when it hit in the fall of 1957. In the first quarter of 1958, the GDP in the US fell 8%, which is pretty phenomenal. And that, again, is a result of this widespread flu and virus. The mortality rate was about 0.5%. In 1968, the H3N2 virus killed about 1 million people worldwide and 100,000 people in the United States, with a mortality rate of about 0.5%. So when you look at those mortality rates, you say, well, that seems to be pretty moderate for a pandemic or a virus epidemic. What we're looking at right now in Italy and China is a mortality rate that's upwards of 7, 8, even 9%. So that gives you some gauge by which you can measure the severity of this pandemic and why it's got people so worked up. I've heard from people who say, well, you know, I got my flu virus vaccine, and I've had the flu before. Flu's not so bad. This is just a bad case of flu, right? No, it's not just a bad case of the flu. This is something that's much more virulent. It's much more easily passed, and it will really affect people in risk groups. If you're over 60, if you've got respiratory problems. The seasonal flu in the United States affects between 5 and 20% of the population each year, with 200,000 people hospitalized and 36,000 people in the US die from influenza each year. Now, those are mainly people of age who are very young. Worldwide, probably 3 to 5 million cases of severe flu, influenza, and 290 to 650,000 deaths, depending again on the virus strain and when it hits. So if we're looking at a mortality rate of 6 or 7%, that's just going to be phenomenal, and it's not going to take very long. We're seeing the new cases increasing 30% a day. And if that growth rate doesn't slow down, that's the big problem for the healthcare system in the United States. So I wish you all good health, and certainly hope that you're following recommended practices. Let's talk a little bit about the financial impact of these past epidemics or these global health crises in more recent times. Obviously, if we look back at how the stock market reacted to the Spanish flu in 1918 and 1919, that's a lot less relevant than if we can look at how the markets responded to some other epidemics of the last 30 or 40 years. This is a graph that Charles Schwab produced in their research division that looks at epidemics and global market performance. So looking at the Morgan Stanley Capital Markets World Index, and they looked at the 1 month, 3 month, and 6 month returns based on after the announcement of an epidemic. And we've had, as you can see, going back to 1981, there have been several major global health epidemics, starting with HIV and AIDS, pneumonic plague, SARS, which you may recall, which is a variation of, it's a type of coronavirus, the avian flu, which is the H5N1 virus, dengue fever, swine flu, which is the H1N1 virus, cholera outbreaks, MERS, which is another form of coronavirus, Ebola, measles, rubella, Zika, Ebola again, and more recently, in last year, a measles outbreak. And you can see that after a month, when we look at this column, let me grab my drawing tools here, and I'll just highlight a little bit. In 1 month, so you can see here, returns tend to be very negative when we have a global health crisis. In 3 months, they tend to range from wildly optimistic to slightly pessimistic. In 6 months on the far right, you can see that 6 months out, the returns of the global markets on average had improved significantly. Again, there's no telling how the markets will react this time. But when we look back at some of these, you may recall a lot of headlines about SARS and about MERS and about restrictions on people coming from countries into the US, from countries that had high incidences of these particular afflictions. So that gives us, just kind of reminds us that the markets do rebound, and past epidemics have only had really a short-term impact on stocks. Now, a lot of these did not directly impact the United States as much as some others. But let's look again at another graph of the S&P 500 and how it performs 12 months before and after a declaration of an emergency. This comes from Ned Davis Research. So we're looking at the S&P Dow Jones index, the S&P 500. The average is in the dark purple, dark blue line. And so you can see the markets are indicated based on the particular global health emergency. So the green line here on the left is the swine flu epidemic from 2009. So the markets had been performing well prior to it, and coincided perhaps with some other macroeconomic factors and improved afterwards. But the takeaway is that on average, the 12 months after these epidemics were officially recognized, the U.S. markets had pretty much discounted them and continued to move upwards. In some periods, they may have had more of an effect than others. But over the last 40 years, markets have survived more than global epidemics. The crash of 1987, for instance, again, many of you probably were not investing in 1987, but we're going to look at that crash, that one-day crash in 87, and compare it to what's happened this week and last week. And it was actually a much more severe jolt to the market. The September 11th, 2011 global tragedy in the US and worldwide really had a significant effect on the market from which it did recover. The Gulf War, the financial crisis of 2007, that's not 2017. also had a big impact on the markets, but the markets did recover. So the question, of course, is going to be, well, how long does it take to recover to these various epidemics and pandemics and global crises and jolts to the market? And there's a little bit of uncertainty to it, but we can at least, again, look back at history, look at bear markets, and gain a little bit more insight, perhaps. So let's take a look at where we are right now in the U.S. stock market. This is a graph of the markets in the U.S. Year-to-date performance for the three segments of the market that I like to track to get a sense of how everything is, how the total market is working. The blue line on top is the S&P 500. The red line is the EFA index. That's the Europe, Australasia, Far East index. That is an index of large cap developed country stocks. So this is a good proxy for the rest of the developed world that's not an emerging market, more or less. And then the green line is the S&P 600, which is my representation of the small cap segment of the market. I prefer the S&P 600 over the Russell 2000 because I believe the S&P 600 better represents the overall small cap segment of the market. The Russell 2000 has some very large companies in it. So as of earlier today, we saw a little bit of a recovery, but the S&P 500 is down 21% year to date. The S&P peaked around February 19th, February 20th, somewhere in there, reached an all-time high, drifted along, and has been declining pretty regularly since then, but it's now down 21% year to date. The EFA index is down 28%, 28.45% year to date, and the S&P small cap 600 is down 36%. Small cap's not getting any love in this bear market initiation stage. We talked about the biggest one-day Dow losses of all time. And March 16th, so yesterday, Monday, was actually the third largest percentage drop in history, behind October 28th, 1929, and October 19th, 1987, where we had a single day drop in excess of 20%. That is what's known as a very bad day in the market. These other 10%, 5% declines, you can see we've had declines of 7% or more, roughly 10 times since the 1929 crash. On this graph, you'll see March 12th, which was pretty high on the list. To have a couple of the top biggest one-day losses of the Dow in the same on the same graph in the same month within days apart kind of exacerbates the impact of the declines that we've been seeing here. So yes, no doubt the market has seen a decline. We are officially in bear market mode. At this point, although we've seen a little bit of a bounce back today, it's going to be a long week on Wall Street ahead of us as investors and traders try to figure it all out. So I always feel like it's useful to go back in time a little bit further. So if we go back to 2010, so we have a nice decade's worth of data here, you can see again how we are still in positive territory for the S&P 500 and the small cap 600. The S&P 500 is up 124.7% in the last decade plus a couple of months. So since January 1st, 2010, the S&P small cap 600 is up 95%. So still roughly doubling in value in 10 years for those broader market indexes. EFA has just been underperforming the rest of the world or the U.S. exchange indexes and is down 10% total for that decade. So the EFA index not performing well at all. There are all sorts of global shocks to the European, Far East Asian markets, Australasia markets that have been hammering that index and companies there. Well, let's dial it back and go back to 2000. So the dawn of the new millennium, where do we stand at that point? And you can see small cap stocks in that 2-decade period up 228% is represented by the S&P 600, while the S&P 500 stocks up 70.9% and the EFA index down 7.92%. Now that includes that 2007, 2008 bear market financial crisis period. We are starting from 2000, so we get a little bit of the 2001 Nasdaq.com crash, but we're certainly not starting from the bottom of the market there. So still puts us in positive territory over the last 2 decades for a broad selection of stocks. And again, that's our perspective is over the long term, and our approach is to continue to invest no matter what the market is doing. And if you can invest a lump sum at any point and more or less see a positive return for stocks, that can be a good accomplishment. But we are in a bear market. So let me be the first to officially welcome you to the bear market of 2020. There are a lot of you who probably have never experienced a bear market. Our last bear market ended in 2009. And so it's been a long record making run of the equities in the market. So I think it's useful, again, for us to look at bear markets and understand them, and that will help guide our decision making as we go forward. So a bear market is usually defined as a 20% decline from the high. A correction is a 10% decline from a high. Like, excuse me for that typo. A 10% decline from the market high. There are some various different ways of calculating when the high is, when the bear market stops, etc. So different data evaluators have different definitions. So this is either the 9th or the 10th bear market since 1920, depending on how you're counting. Again, we might have a prolonged decline of 19% that wouldn't be categorized as a bear market by some measures, but others might include it. It's important to recognize that some sectors and market and sectors have their own corrections in bear markets. So small cap stocks, according to the S&P small cap 600, went into a bear market last week because they declined more than 20%. And it's what we expect from small company stocks. They're going to be a little more volatile. They're going to decline a little bit more than large company stocks. But if you think back a couple of slides ago, the small cap stocks give you better returns during bull markets. So we accept a little more risk. We get a little more return from it. When we look at bear markets of history, going back to 1966, the average bear market has lasted roughly 17 months. That's it. Much, much shorter than the average bull market. But bear markets, just like bull markets, tend to end and start abruptly and are impossible to predict. There are always going to be some market pundits who claim that they called the last market change. And it's possible that they did, but there are very, very, very few who do it consistently, and that's sort of the point. You can be lucky once or twice. You might be lucky several times, but in order to predict the market on a profitable basis, no one has really figured that out. And that's part of Better Investing's, the rationale behind Better Investing's guidance to not try to time the market, not try to guess when the market's going to end or when it's going to change direction. But as long-term investors, we have the advantage of looking out to the future. And so no matter where you are in the market cycle, bull market, bear market, corrected market, sideways market, if you think about where we're likely to be 5 years in the future, the answer is always going to be better than we are now. The market's going to be higher than it is now. So that's why we talk about staying the course, staying true to the principles, remaining disciplined. Don't sell during a sell-off just to when everyone else is. Don't act out of panic, but look at the market from a rational, calm perspective and make your decisions accordingly. If you look at the peak to trough returns of the last bear markets and bull markets going back to 1966. This is from the Schwab Center for Financial Research. You'll see something. The blue markets are the bull markets. So the length is indicated by the axis on the bottom. The height of the market indicates the size. The height of the blue box indicates the total returns of the market. So you can see that on the left side of the graph, you'll see little red boxes and little blue boxes. And then the blue boxes start to get bigger and bigger. The red boxes turn into rectangles, but they stay pretty small. But the blue boxes get bigger and bigger and bigger. So there's been a trend in place since the end of the 80s when we embarked on the record making bull market of the 1990s that coincided with the dot-com boom, where we got a lot of returns from equities, and then our bear markets tended not to last very long. Even if they lasted long, the negative returns tended not to be very high. So there's a trend in place that suggests that we're more likely, since in the last 30 years, to have bigger bull markets and smaller bear markets, and that will give us a little bit of what we might expect going forward. Here's another graph that looks at the bull markets and bear markets. So we see a different perspective here, going back to the mid 1920s. And so again, the big blue sections are the bull markets. The little orangey red sections are the bear markets. And in order to accommodate the massive bear market of 1929 to the early mid 30s, this graph scale has to have a big bottom on it. But when we look at the bear markets from these points, you know, they have been much smaller in scope. They've not taken up very much time before we see on the top here these big bull market phases of the market. And there are lots of reasons that we could point to from a fundamental perspective why equities have been performing well, why the economy is more efficient, why the investors have been investing in US stocks or global stocks, but that is certainly pretty evident from this graph. And again, we're not predicting the future, but we're just pointing out that we've just ended this record bull market. What do you think we might expect from the bear market that we've just launched as we go forward? Well, generally, I'm a fan of market corrections and market pullbacks. A decline in the market can often wring out the excesses. It's probably no surprise to those of you who use the stock selection guide, who are using our toolkit program, who are analyzing stocks from a long-term perspective, that PE ratios tend to be much higher in recent history than you might have seen 5 to 10 years ago, as the bull market has kind of kept these stocks at a high valuation, as interest rates have been so low that people who might otherwise have gravitated towards keeping more money in the bank, where it's nice and quote safe, or where they might be investing in the bond market, they're not seeing enough return from those cash proxies, so they're turning to equities and thinking, well, you know, it's been working for a long time, for many years. Maybe this is a nice, safe place to be. Other people recognize that maybe it's a little risky to be in the market, but there's no alternative, and there's actually an acronym for that, TINA. There is no alternative. The stocks that's kept a lot of money in the market as it's been on its historic run. So to see stocks at a more elevated, a more reduced valuation could be a good thing. If we look at the long-term trend of the S&P 500. This is from 1982 to present, the S&P 500 index. And this is also on a logarithmic scale. So we're looking at the rate of change of the index, which is why it's a little more subdued. But from this, I think we can glean a little bit of the long-term trend. And certainly I've plotted on here, as I was looking at this graph, certainly there are some different stages of the market. We can see the scope of the 2001 downturn. We can see the financial crisis initiated bear market of 2007, but we can also see, so since 2008 or so, we can see where we are right now relative to the highs the market's reached, and we're in that kind of interesting range where maybe there's a feeling that the trend might be bottoming out at some point very soon. If we got a little bounce today, I wouldn't expect we're going to start the recovery for another couple of months before we would see the market start to show some upward movement in the least. But it's kind of giving me a little sense of that long-term trend that we get a little bit of a regression and then a resumption of the upward movement of the market. Just looking at the data, the average bear market loss since 1929 was 35%. So we're down from the high right now, just over around 20%. We came back up today, put us back a little bit. The smallest bear market in 1949 was a decline of 21%. The largest in 32 was a 62% decline. Very interesting if you study the history of the market and you look at the Great Depression. That stock market crash of 29 was kind of bad, and it shook a lot of excesses out of the market. However, a lot of money came back in and was buying on the dip, in essence, and they got washed out in short after the abuses that were going on in the market hadn't been corrected, and so and the economy slipped away, and so we saw that 1932 bear market be the worst. On average, we've had a bear market every 3.4 years, but our last bear market ended March 2009. So congratulations, everyone who's here participated in the longest bull market in U.S. history, which was ran from 2009 until March of 2020. Yeah, give yourselves, a nice congratulations card for being part of it. It is a record. It's something to kind of marvel at. As we enter this bear market, got to keep in mind that every bear market in U.S. history has eventually ended. It's 100% success rate of seeing bear markets end. So we don't have to worry so much about that this is the market, the bear market, that's going to drive every stock down to zero. And if you really believe that, you would probably wouldn't be here, because you wouldn't be interested in stocks. You'd be interested in gold, ammunition, canned goods, bunkers, and an even larger stockpile of toilet paper than the average hoarder these days. The average bear market has only lasted 10 months. So again, so we might have an above average bear market ahead of us because of all that's going on. But do we expect it to be a 10-year bear market? That would not be supported by any data that we have. Would it be a 5-year? Again, we have not seen bear markets of that size, of that length. So if it's not 10 months, if it's a year and a half, that would be within the realm of our experience with how the markets performed during the bear cycle of the last few years. So this too shall pass. Bear markets are tough on the emotions. We'll talk about some things that you can do later in our presentation tonight. After a bear market, the next concern that many people will have is, so are we about to enter a recession? Well, let's talk about recessions for just a couple of minutes. A recession is defined as 2 consecutive quarters of declining gross domestic product. Uh, if you think about that, we only get the reports about GDP growth. We get estimates and then final figures a couple of weeks after the quarter ends. So in order to have 2 consecutive declining quarters, we have to wait until 6 months after the start of the recession before we can recognize the recession as actually starting. And the National Bureau for Economic Research is the nonprofit group that's the arbiter, internationally accepted as being the determiners of when a recession starts. So there's a lot of chatter that we're probably already in a recession. There's the UCLA, they had published the Anderson forecast, and they, for the first time in their 50-plus year history of economic conditions reporting, issued an update in the middle of the week that said a recession has likely already begun in the United States. And I wouldn't argue with that assumption. A recession, and we'll talk about what they are, but we can expect, if we do have a recession, a big drop in overall spending by consumers and businesses, unemployment, decreasing RV sales, declining trucking volumes, lower house prices. Those are some things that we can consider. But recessions tend not to be very predictable. There are all sorts of moving parts in an economy, and there's many facets of U.S. and global business that don't move in sync with each other. And this recession has been, or this expansion phase that we're currently in the U.S. that's been going on, since for the last 10 or 11 years, has been very mixed in that we've got pockets of strength and we've got pockets of weakness, and we'll have 1 month manufacturing starts that will be stronger and housing starts will be a little weaker. And so economists will be talking about, on the one hand, we have this factor that's a negative. On the other hand, there's this factor which doesn't seem to be so bad. And then a couple of months later, things will flip-flop. You never get all of the components of the economy moving in concert in the same direction. But I think anyone that you ask from a consumer perspective, things have been pretty good. Unemployment's very low, and that's created some problems because low unemployment means that you can't find workers if you need to expand your business. So, but definitely something that we can take a look at. We hear the word recession quite a bit. The economy in the U.S., it expands and it contracts on a regular basis. And if you think back, 150 years ago, if you were manufacturing buggy whips or wagon wheels, you might be doing it on a completely on-demand basis. Someone says, I need a new wheel for my wagon, and you make it. At some point, maybe you decide, well, I'm going to make a bunch of wheels of a standard size so that I've got it in stock. If somebody wants a wheel, I've got it. I've got some downtime, right? And so as that business expands, you hire other people. Now I'm going to make a bunch of different wagon wheels for different size wagons, but you have no idea what the demand is really going to be. If it's a bad winter, maybe you expect the business goes down a little bit, but there's no way of predicting that in advance. So your ability to forecast is very limited. Your ability to meet demand is completely haphazard. And so that same model, you can move it forward to Henry Ford and the manufacture of automobiles. At some point, he's making cars that are really a novelty and they become in demand. And so there's a lot of capacity. He's figuring out how to make them more efficiently, more cost effectively, more inexpensive for the end consumers. But again, he doesn't know what's going to happen if we have a world war that's going to cut into demand for automobiles, and what's going to happen there. So the risk is that he stocks all the parts for his cars, And then all of a sudden there's an event where nobody wants that car anymore or that model anymore, or there's competition that comes in and you're stuck with a warehouse full of supplies and parts that can't be used, right? So if you fast forward to the 1960s, where you have companies like Toyota who are figuring out that they can use technology to help them predict predict demand a little bit better, and they can also, instead of stocking up on parts in their warehouse, they can put the onus on their suppliers and say, all right, when we order these parts, you promise to deliver them in 72 hours, back the truck up to the assembly line, we'll load them off and we'll use them just in time. We'll use them right as we need them. And that way, Toyota isn't stuck with car parts for a car model that falls out of favor, or that a recession hits and people stop buying new cars, and now you've got a warehouse full of parts that can't be used. And so that level of forecasting helped. Fast forward again into the 80s and 90s and 2000s, as computers became more ubiquitous, then we can figure out how to cut that supply chain time of delivery even less. We can work on forecasting demand even better. We have a tighter grip as business people on the effectiveness of marketing. And so that's really helped kind of get rid of this whipsaw effect of the market. But the market can be explained, the business cycles of the market can be explained like this. In a typical expansion phase of the economy, this is when products and service supplies grow. So we see in that expansion phase, this is where we've been for the last 10, 11 years. In the US, the economy has been expanding. It's been growing. We've been, and again, it doesn't have to grow in every segment, but we've had housing starts and automobile sales have been pretty robust. Eventually, we reach a point where supply it gets ahead of the demand for products and services. That's the peak of the cycle. Once that happens, if you're making something and all of a sudden the demand drops off for the product that you're making, you slow down making that product. And that might include laying off workers. It might include shutting down particular factories. It might include other efforts at cutting costs to maintain profitability. So that stage of the business cycle where manufacturers and suppliers are cutting back on production, they're laying off workers, and now those workers are unemployed. Those workers are now spending less. If consumers are spending less, that leads to reduced demand. That's the recession cycle, and that cycles through there until eventually a bottom is reached, where companies have kind of wrung out all the efficiency. The workers have found new employment in perhaps in other industries, other sectors, or they've taken themselves out of the workplace entirely. And at some point, when the business cycle reaches that trough, then we enter again into the expansion phase, and manufacturers and suppliers ramp up. They start rehiring workers, there's more spending, and we've got more demand until that cycle repeats. The graph looks something like this. We've got our peaks and our troughs. We've got our recessions going down and the expansions going up. And you can see the idea is that it may be 3 steps forward, 1 step back, but that puts us 2 steps ahead, 1 step ahead or 2 steps ahead at every peak of the cycle as we get bigger and bigger and bigger. It's important to recognize this cycle and understand it because of the way that we analyze companies. We want to know, are we in an expansion phase of the economy or the recession phase of the economy? Because not all companies and industries and sectors are affected to the same degree during a recession. The defensive super sector includes healthcare, utilities, and consumer defensive sector stocks. Those don't see the same downturns during a recession as cyclical and sensitive super sector companies. So cyclical stocks tend to be technology stocks, and consumer cyclical businesses, travel companies, automobile makers, large equipment manufacturers. These are highly cyclical because if you're in a business cycle where there's lower demand for your products, you're not going to be manufacturing lots of expensive bulldozers if you're Caterpillar if the market demand is not there for your bulldozers. So you shutter plants, you lay off workers, right? So that's a very sensitive, very cyclical industry. Sensitive super sectors are somewhere in the middle. Defensive super sectors include the consumer defensive stocks like grocery stores and discount stores. Discount stores tend to be very resilient during recessions as people, as consumers move down market in their retail spending habits. So I would, typically stocks like Walmart perform better at the beginning of a recession as people kind of downshift, maybe are more price conscious. They turn to Walmart initially. It doesn't tend to last at Walmart. Walmart is kind of a big behemoth, and it's hard for it to capture big trends, and their margins are so minimal at this point that they don't have the ability to navigate low profit, low margin items in the retail marketplace so much. But healthcare stocks again tend to be super resilient to the recession because healthcare costs are not generally paid by consumers; they're paid by the government, Medicare, Medicaid. They're paid by insurance plans. Customers don't tend to pull back on essential healthcare during a recession. Utilities companies, of course, because their prices are government regulated, so they are set up to make money no matter what goes on. They're not big growth opportunities, but they're paying dividends. So if you've seen some of my webinars in the last couple of years, we've been talking about being defensive and including a healthy portion of super sector or defensive super sector stocks in your portfolio at all times. A lot of clubs already have healthcare stocks. You might have a consumer defensive stock, a grocery store, or a Dollar General. Again, great consumer defensive company. Probably not a lot of utilities, but again, be open to the prospect of a utility. This advice in hindsight doesn't do you any good, I understand. Now's not the time to go all defensive because it's already too late. But something to keep in mind as you look at the portfolio allocation of your holdings by sector and super sector is try to figure out where opportunities might be. But then just like with bear markets, recessions have been getting shorter. Here's a graph of recessions and expansions since 1925. The red line is the S&P 500, so you can sort of see how the markets perform. The white areas of this graph are the expansion modes of the economy. The brown shaded areas are the recessions. And what's really interesting, if you look at the left side of this graph, you see almost like the picket fence. It's very regular, those brown lines standing up. We have a longer expansion in the 1960s. That's the go-go years, the technology boom, the race to put the man on the moon, drove a lot of research and development and technology stocks in the market. In the 1970s and the 74, 75, you see a big, thick brown pole standing there. That recession during the mid 70s related to the energy crisis, and we had a bear market as well. And then in the 1990s, we had a historically long expansion, and then from 2009 on, the historically longest expansion of the market or of the economy that happened then. So again, as you look at this, the recessions are obviously have been occurring with much less regularity since the mid 1980s, and the expansions have been much longer. Part of that is the shift of the American economy to service economy from a manufacturing economy. The U.S. is much less dependent on making automobiles and big equipment. The Rust Belt obviously went through a tough time in the last 50 years and has not emerged victorious, so to speak. But technology companies and service providers are now the new driving force behind the economy. It's making it a little hard to measure economic progress in the U.S., but that I think is one of the key contributing factors to why we're seeing these longer expansion phases. If you look at the numbers from 1854, economists are crazy. They go back in time, they recreate the national economy, and they were able to calculate from 1854 to 1945. The average expansion was 29 months. The average contraction was 21 months. So really, a little bit forward, and then back a whole lot. And then we're starting all over again. Since 1945, the end of World War II, till today, the average expansion is 60 plus months, and we're on an expansion that has been 130 plus months. So you can see this most recent expansion so much above average, and the average contraction just about 10 months. Contraction and recession are synonymous there. So bear markets and recessions are not as connected as some people think. Only twice in history, however, has a 20% stock plunge not been accompanied by a recession. So if we have a bear market, yeah, chances are good, very good, we're going to have a recession. And it's, as I mentioned before, it's likely we're already in a recession in the US, and if not, we're looking at a quarter or two of greatly diminished growth. We've got 2 weeks of virtual shutdown ahead of us for the restaurant and retail and a lot of other industries, and so that's definitely going to take its toll. There are some, as we look ahead, during a recession, whenever we have a recession, all politicians in Washington become socialists, and they just call it different. They have different words to describe it, but we can expect bailouts. We can expect quantitative easing. That's already happening. We can expect reduced interest rates. That's already happening. We can expect increased federal spending, what is commonly known as stimulus. That's already happening. There are talks about giving cash to everyone in the country, $1,000 per person. Again, that is a federal cost to prop up the economy. These tend to reduce the length of the typical recession, which is why some of our recent recessions have been a little shorter in duration, and why I'm not quite so pessimistic. I'm very pessimistic about the health scenario in the U.S., but I think that when push comes to shove, the government will go even deeper in debt to try to pull the country out of that the recession that is undoubtedly going to come. So realistically, best case scenario in my viewpoint would be 1 or 2 quarters of a recession before we see recovery. We've seen pandemics in the past, as I mentioned, the Asian flu in '57, where the GDP dropped by 8%. I've seen analysts today talking about first quarter corporate profitability ranging from 0% to 0.7%. And again, first quarter is only going to, 1/3 of that will be March. January and February were pretty good months for the overall economy. So corporate profitability for the first quarter may not be so terrible. Certainly we'll expect to see a lot of guidance from companies in their first quarter reporting about what's happened since the end of February and what their guidance is for the year to date. And I expect a whole lot of companies, FedEx reported today, and discontinued guidance. We're going to continue to see that trend. Companies are just not going to put their necks on the block to try to predict where things are going to go from now. And that mystery is part of what's causing market behavior. Again, if we look at history, recessions typically resolve in months, not years. The UCLA Anderson forecast predicts a resumption of normal economic activity and economic growth rate of 4% in the fourth quarter. So they say we're in recession. They looked at the impact of the pandemic, and they're seeing a resumption of growth in the fourth quarter. They're seeing, now that could be a very long remaining 6-7 months of the year before we get to the fourth quarter. But that is a very interesting and not such a doom and gloom forecast. I haven't seen a whole lot of other forecasts of anyone where anyone is willing to stick to some numbers there, but they have made that call, which I think is kind of interesting. Again, I think that's the very optimistic outlook, but it's not unrealistic at the same time. So let's talk about what you and your investment club can do now. We'll try to wrap things up. Yeah, they're near-term winners and losers. It's clear that restaurant stocks, airlines, cruise lines, hotels, casinos, travel companies, these are just getting decimated in the near term. It's going to be really rough to see what happens to the major U.S. airlines, major international airlines. Air Lease, one of my favorite stocks, is just in just terrible territory, down 58% or something year to date. It's just really unfortunate. Obviously, companies connected to China are going to see a significant impact. Part of that, the impact of the China connection, where China has shut down for probably several weeks, where they were where everyone was under house quarantine, and companies were not making parts and goods and export items. Part of the trade wars the U.S. has been having with China probably are going to mitigate that a little bit, as suppliers in the U.S. had already been seeking alternative supply chains for their goods that didn't depend on products coming from China. And so that may help companies a little bit and mitigate some of that impact of the slowdown in China. It goes without saying, there's really no place to go to try to make a quick profit by buying companies that make masks or antiseptic products or vaccine makers or pharmaceutical makers. There's been a lot of rumors and the herd's already run up prices. A lot of that is just traders taking advantage of opportunities and gullible investors. So I would counsel you against trying to figure out who's going to be the near-term winners from this particular scenario of economic growth grinding to a halt, stock market in bear territory, and a large global impact of the pandemic. Now, on the long term, well, that's another story. Warren Buffett has often said it's good to be fearful when others are greedy and be greedy when others are fearful. And that, I think, is relevant to what's going on in the markets right now. We've got a lot of people acting out of fear. If we can be rational and we can look at the market from the perspective of not what's happening for the rest of 2020, but what's going to happen by the time we get to 2025 or 2030, what's going to happen to the economy and the stocks that we own in between now and then. Certainly not every stock we own is going to be a winner over the next 5 to 10 years, but if we have that framework and we take advantage of opportunities now, we can come out ahead over the long term. So we want to stay the course first and foremost. The market might go up. The market can continue to go down. If we had a 30% decline in the market, I would not be surprised. I think that's less likely, but it is a possibility. Definitely don't sell. I'm surprised, but I do get emails that say, gosh, look at some of these stocks. They're down 20%, 30%. Shouldn't I sell them? Well, you're just selling at the bottom. You bought them at the high, and now you're selling at the bottom. That's the wrong way to make money. You will never make money in the particular market. But I'll give you some more guidance on some of the stocks you might hold at a loss in a couple of minutes. So focus on the long term and look at the valuations of stocks that are selling right now and think about how they may perform going forward. You want to mitigate, or you want to ramp down your growth rate expectations, because there's going to be a lot of stocks that are not going to be growing at the same pace this year that they were last year. But hopefully by the time we get to 2020, they will have rebounded and be on an upward trend once again. So we want to, our approach, and the better investing approach, is to keep investing in stocks. Bear markets are where the wealth is made over the long term. If I had my druthers, now that I'm still investing in my 401k and I'm, looking at retirement and putting money aside, if we had a bear market that lasted 8 years until I was uh, much closer ready to retire, and at that point we went into a bull market phase, and all the money I've been putting in during the bear market, this extended bear market, all of a sudden started to see massive gains, I would be very happy with that. So for your investment club, think about the bear market and look at the unit value and think, now this is the same portfolio we had last month, but now I'm getting so many more units for my dollars than I was before. And so let me continue to put the money in or even increase it. If you have stocks showing losses and they're depressing you, well, first of all, if the companies are viable, do your analysis. It might be best to hold on to them. In other cases, it might be a great idea to sell the stocks that you're holding at a loss, record the capital loss, which you can use on your personal returns next year to offset any gains you might have or to offset even ordinary income, but turn around and immediately invest in a different company that's selling at a bargain price. Hopefully it's a company maybe with a little faster growth potential or total return potential. If you use that strategy, you just kind of move from stock A to stock B. They could be similar, but there's no reason they have to be. You could capture the losses, but yet still remain 100% invested in the market. Of course, the problem with that is you never know. Will stock A or stock B perform better going forward? We don't know about it. But having that loss to deduct against ordinary income to reduce your taxes next year could be a worthwhile thing to take advantage of. So you can certainly do some portfolio analysis of your club's portfolio right now. But first and foremost, challenge your stocks. Look at all the stocks. Some of them, you may determine are not worth holding on to for the year or 18 months that it might take for them to recover. If we do have a recession, or if we have an extended recession, some stocks may see their prices decline, and investors get gun shy of companies that don't perform well, and then it can take a couple of quarters before they come back, and so it can be a zero-sum game to chase after stocks or to hold on to stocks, even if they look good. If the rest of the market doesn't like those companies, you're just not going to get ahead. But I like the challenge tree, the challenge function. We own this stock. Here are a whole bunch of other ideas. If you plot them and calculate what your potential total return is, or if you do a conservative analysis and you adjust your PE ratios accordingly, and stock B just is giving you a better total return potential, why wouldn't you change at this point when you're not generating capital gains on the sale, more likely than not, or the gains might be minimal? So redirect those ideas. Do that on a regular basis each month over the next couple of months. Look at one or two of the stocks that you own and really see what do we have, what other ideas can we come up with that might work better for us. I talked about investment clubs, continuing, staying the course, and that includes sticking with your regular monthly meeting. It's important to continue to meet, continue to share your thoughts on the market, continue to work as a cohesive team to find opportunities, to provide support for each other. But it's also important right now to maintain your social distancing. I understand that. Fortunately, there are a lot of free and low-cost tools that can help your club meet regularly. If you are here in our webinar, there are tools that work very much like this, that you can conduct a meeting with a group of 10 or 15 club members that will allow you to share your screens, that will allow you to talk, as I'm doing now, to you. You can share your meeting minutes, you can conduct votes. And so here are my 4 top picks, roughly in order of reliability and feature richness, and these are all free for personal use. So WebEx comes from Cisco, and this WebEx tool for meetings just is terrific. It's very functional, very full-featured. TeamViewer is primarily a program that's used for remote management of computers. For instance, I travel quite a bit, as you probably are aware. So I have a computer at home that I can reach from my laptop. So if I need files that are on my home computer, uh, I can easily connect to it using TeamViewer, but it also supports an online presentation meeting mode with voice over IP. Free conference call has an online meetings application that works very similarly to WebEx and TeamViewer and GoToMeeting. And again, it's free. So you can download that tool, set up your meeting. And many clubs have used Skype in the past. I found it a little clunkier these days as Microsoft has migrated it towards its business users, but they do have that group functionality. There are some other options like Google Hangouts that people use. People talk about Zoom. Zoom is an option, but it limits your meetings. In the free version, you're limited to 40-minute meetings. I know some of you are going, gosh, if I could get my club meeting done in 40 minutes, that would be great. So then take a look at Zoom if that's an option. But Zoom is focused on the business market pretty significantly, and the education market. And their basic program doesn't support calling using your telephone because of the demand for that particular tool. But I think you'll find some options here. Check out WebEx, TeamViewer, free conference call as module. And I think those will be some good opportunities for your club meeting. Got an article in Better Investing Magazine in the May issue that'll be in houses in April, where we'll talk about these tools and provide some more tips for them. You may have some members who need cash during the coming months if they're been laid off from work or furloughed, and so they may turn to their investment club account and want to tap into it for some cash needs. And that's part of why you're investing in your investment club and your personal portfolio. I would suggest not penalizing any member for withdrawing portion of their funds due to economic hardship. If you charge a withdrawal fee, again, I would consider waiving it for those people due to economic hardship. Allow them to withdraw some of their funds from the portfolio. From the club account. For your club portfolio, as always, member withdrawals are the opportunity for you to get rid of stocks that might not be performing up to par in order to generate the cash for the withdrawal. The MyIClub withdrawal scenario calculator, I will remind you about that tool, helps you determine the best payout methods for the club and the member, whether cash or cash in stock are best for it. I would discourage your members from withdrawing due to panic or fear of the market. If you're depressed looking at your club's valuation statement, guess what? Let's just suspend that until for 3 months, where we're not going to look at the valuation statement. That doesn't hurt anything if you've got a long-term perspective, and it might help kind of buoy the spirits of your members. And remember, this is a great time to be putting new money in the market. This is the perfect time on a monthly basis to be putting money in the market. The Mutual Investment Club of Detroit, which was one of the original founding members of the National Association of Investors back in the 1940s, they had many of their younger members were called to serve in World War II, and those members who went off to Europe or the Pacific during the war continued to send their $10 back to the Mutual Investment Club, and the market was not performing well, but the remaining members continued to run the club during those periods of extended bear markets and downturns, and that club in its 50 plus years of history really learned that during bear markets, when you continued to invest, you generated an upsized return that made it all worthwhile. Unfortunately, the trend that we see is that during the bull markets, everyone gets excited and forms investment clubs, and they're really excited because the returns go up. And then when the bear market hits and they've lost their 20%, they get really depressed and they want to disband their club. And that's the exact opposite of what they should be doing. So let's not focus on the negative returns in your portfolio. I would point to, in MyIClub, the benchmark report, which allows you to compare returns to the broader market indexes for specific periods. So compare your club return to the S&P 500 or the Wilshire 5000 just for a shorter period. So since the bear market started, and see how you're performing in that period, for instance. Give you some context for how your club is performing, not just look at the numbers. Oh, we're down 12%, 18%, 22%. If you're down 12% and the market's down 18%, guess what? You're a winner. You're doing much better than 80 or 90% of professional money managers and mutual funds with that. Yeah, you're losing money on paper, but with a long-term perspective, you'll have the opportunity to make that back over time. One of the things that I used to do in my club when my club disbanded, my last club disbanded a couple of years ago, but we every time we had a bear market or a market decline, I increased my monthly club dues contribution, and that enabled me to have a higher rate of return than my members who put in the same amount every month. So my compound annual rate of return was higher because I took advantage of the market downturns to put in more money, buy more units when the market was down. Then when the market and the portfolio came back up, I ended up coming out much further ahead. So feel free to not share that tip with the rest of your club members. I won't judge you, but it can, if you are a believer in the long-term nature of the market and you put your money where your mouth is, you're making a statement to the rest of your club members. It's going to help them to navigate this bear market until we have reach a more a clearer have a clearer picture of where the market is going. I understand there's a lot of uncertainty going ahead. My aim tonight was to provide a little bit of history, a little bit of background. We're scheduling more webinars at Better Investing to support clubs and investors and Better Investing members during these times. Continue to point out the history and keep tabs on the market. We're looking at commentary from the Better Investing archives that came after September 2011, that came during the bear markets of the 1970s and 1980s, where the single driving motivation of those editorials was, yeah, we've seen this before. Yeah, it's pretty bad. Yep, could get worse. But if you believe in the long term, you're going to see the rewards of sticking in the market when it's all said and done. So that's my final word for you tonight. Time for one question. I see Dean asked, would I recommend staying with our small cap Informer stocks, especially some of the retail stocks like Five Below and Boot Barn? I don't have an answer for that yet. We're working on the small cap Informer and the Investor Advisory Service this week for publication next week. So I'm not going to publicly talk about specific companies right now. The Investor Advisory Service has not made any sale recommendations since the market started to decline. There have been several stocks that have overshot our 10% decline figure and triggered some alerts, but there's been nothing so far that's making us say it's time to sell any of those stocks with our long-term perspective. We're going to kind of stick with that. So we'll be reaching out. You subscribers will be hearing in the next issue. I expect more from both of those newsletters. Rusty has a very interesting question about the correlation of pandemics and the market returns. Obviously, there are other factors that influence the returns of markets relating to 9/11 and pandemics and high global health crisis in the past. So I don't think the intention is to point to the necessarily there's a cause and effect relationship, but the impact that those global crises had on the broad markets, if the impact was there, it was not long lasting. The markets did all tend to have short-term, near-term declines after those health crises were initiated, but the declines did not last long. And so the inference there is from Ned Davis research is that as terrible as some of those pandemics and health crises were and other global events, the effects on the market are not, exceeding a year, a year, going out a year. In most cases, the effects don't seem to be very long-standing. Yeah, there's all sorts of other factors that go to play. So we're not saying that. And again, this time could be different. This time probably is a little different. Is it going to be as bad as the Spanish flu of 1918? That would be pretty serious, but we don't have anybody around who remembers that, and so we don't have a frame of reference to gauge the severity of the outbreak. So all we have is a lot of uncertainty. And the hopes that we continue to move in the right direction in the U.S. And that will mitigate the effects and certainly shorten that curve, flatten out that curve. Deanne asks, do you know of any healthcare companies to buy that should have a nice run with the virus? Again, I don't think there's any opportunities that I could give you that lots of other people have already thought of. There have been companies like Regeneron even today that had a nice bump because they believe they have some treatment/vaccine that they're rushing into testing and bringing to market. And again, it took a big jump up, but after they make that announcement, it's a little too late to try to gain from that investment. So I would again just focus on the long term. I think in the short term, it's just too tricky to try to play you're playing whack-a-mole with what stock might be the next big winner, and you just never know where it's going to pop up. So I would stick away from that. All right, well, let's thank you all very much. And we will, please feel free to email me. We're going to archive this on our YouTube channel. So look for iClub on YouTube, and we'll also link it from our Facebook page. Look for iClub on Facebook, and we will link it from the iClub.com website probably tomorrow. You'll expect to hear more from us, but please let me know your concerns so we can address them at future webinars. Thanks so much for coming out tonight. We'll look forward to seeing you next time. Everyone, stay the course. I wish you all the best, both for your health and the health of your portfolio.